Everybody loves talking about the next hot stock. Right now, there are 3 great companies that I already own that are on my list for October to add to, but only if they hit the value that I need them to hit. A very common question is, Paul, what stocks are you buying right now? My answer is always the same. Depends on price. I have a list of great companies. I have a list of stocks I currently own. When the price makes sense, I purchase. Because a great company at the wrong price can become a terrible investment. That's why I focus on value versus price, not hype. So in this video, I'm going to walk you through these 3 stocks that I plan on buying before October ends, but only if they sell at the right price. And the best part is, guys, little spoiler, I'm going to get paid to wait for those stocks to hit the right price. When it comes to investing, it's not about what you buy. It's about what price you're paying for what you're buying. More importantly, in this video, we're going to help you level up by giving you the tools and principles so that next time you analyze a stock, you're going to have an advantage over 99% of investors in this world just by thinking this way. Now remember, these are stocks that I currently own. Don't buy them just because I own them. That's an absolute no-no. I don't care who's out there. I don't care if it's Warren Buffett bought a stock. Don't buy because he owns it. We're here to teach a process, and we're here to show you the thought process behind the stocks that I own. But it's important to learn that process. Stock number 1, PayPal. Now, if you're like me, back in the early 2000s, chasing tech stocks with no clue, you'd hear PayPal and think, oh yeah, that's how I used to pay for eBay junk. But here's the thing. PayPal is a lot different today. It's no longer just a little checkout button. It used to be part of eBay, then they spun it off. This company is building something much bigger. And for us as value investors, that's where the intrigue begins. The world is moving away from cash and checks. You've probably noticed that when you go to the store now, you're not sitting behind somebody who's writing a check. Everything is digital. That global shift is a massive tailwind for companies like PayPal. Every time someone swipes, taps, or Venmos, PayPal's skimming a little bit off the top. They own Venmo. That's huge. This is the kind of recurring revenue I like to see. It's sticky and it's scalable. And guess what? E-commerce is still going to continue growing, even in mature markets like we have in the US. That means more online transactions and more money flowing through PayPal's ecosystem. As investors, we want companies that build moats, things that keep competitors out. PayPal is doing just that by expanding beyond its core payment service. They have now buy now, pay later. This option has a much higher average order value. People spend more when they use it. It's driving new users and more revenue. Now, of course, buy now, pay later is not risk-free, but PayPal has the data and the scale to do it intelligently. I don't like this, but they're also into crypto. Look, I don't invest based on the crypto hype, but I do respect infrastructure plays. PayPal's stablecoin and their pay with crypto feature position them to capitalize if digital assets become more mainstream. It's optionality. Optionality is good. Now, let's talk customers. PayPal has over 400 million users that are active. That's a gold mine of data. And now they're building an ad platform. This could be humongous. Ads are very high margin. Look at a company like Amazon. Amazon's next big growth is in their ad section. Look at Google. Look at Meta. All their money is made from ads. If PayPal can leverage its user insights to serve relevant ads, that's a brand new revenue stream without needing any more users and very, very high margin. And like I mentioned earlier, let's not forget Venmo. It's no longer just for sending money to friends. They're monetizing it. Debit cards, instant transfers, business payments, that's more money per user. And remember, guys, it's the verb. Venmo me, Venmo me. Here's where the investor in me gets excited. PayPal is working on PayPal World, which is a global network linking PayPal, Venmo, and other platforms all together. This opens the door to cross-border commerce. That's a massive market, and very few players can do this at scale. On top of that, they're partnering with AI leaders like Anthropic and Salesforce to make commerce much smarter. Think about this like personalized experiences, fraud detection, real-time analytics. Again, this isn't just flash, it's actual substance. So the question is PayPal a buy? Guys, again, I'm not here to say buy like some clown out there on YouTube. I don't care what the stock did yesterday or where CNBC or some analyst says it's going tomorrow. What I care about is this. Do the fundamentals make sense? Do I understand how this business makes money? Do I believe this business will be around for a very long period of time? But most importantly, am I paying a price that gives me an adequate margin of safety and an adequate return on that investment? We're only going to find that out by looking at the numbers. So let's go check that out right now. So guys, PayPal's currently at $67 a share. What I want to show you is this. It hit a high of $310 a share on July 26, 2021, over 4 years ago. And I guarantee you that back then people were saying PayPal is awesome. And then this happened. Guys, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. The question is there more substance behind PayPal than the recent stock decline is giving it? This company generated $5.3 billion in free cash flow last year, which was higher than its 5-year average. So when I hear people say it's a declining business, I go, then how's free cash flow going up? It's only selling for 12 times free cash flow. Guys, historically, the market is 15 to 16 times on average businesses. This business has above average numbers. This is a return on capital. What this means is, do they get a good return on the money that's invested in the business? If it's above 9 or 10, that's better than most, and it's increasing. The 5-year average was 10.6%. The 1 year is 12.8%. Businesses that are able to get higher returns on the money that are that they put in the business are going to grow much faster. They're premium companies. These metrics are so important. What I want you to do, though, is if you're new to the channel especially, I want us all speaking the same language. I have an absolutely free PDF that's just a shortcut for you. Instead of sitting there and watching 10 videos, it allows you to have those key metrics right in front of you that you can refer to at any given time. Just click the link below, and within a minute or two, you'll have all these key metrics sent to you with a description of them and why they're important. This is so important for leveling up your investing game. So if you've watched other videos and haven't done it yet, please do it, because I really want us speaking the same language so you get the most out of every single video. So let's look at the 8 pillars here. Guys, it's actually an 8-pillar thriller, but remember, this doesn't mean buy it. It just says there's a lot of good things happening here. They're buying back shares, a lot of shares that are cheap. Their cash flow growth is up. Net income's growth is up a lot higher than cash flow. I'm going to wonder why that is. I don't know. $2 billion in net income growth versus $1 billion in free cash flow. But these metrics, they're low. This is something not to ignore, especially for a company that can keep increasing its revenue. So let's see what analysts are saying about this company. $5.35 a share in profit this year, growing to $8.43. Okay, pretty solid. Nothing to write home about, but not the dire that everybody says. And revenue growth, 4.5%, 6%, 7%, 3.5%, 7% revenue growth. Again, hard to say the company's dying when it's increasing its revenue. Now, Mo, why don't you show us the charts on PayPal?
Well, this is interesting. Okay, so let's look at the long-term chart here. This is a 50% rule stock. So what does that mean? Well, you have your high right here, your low, actually your high is kind of here, and it's going to be very challenging to get through, I don't know, $85 a share. Why? Because it just has all of that negative pressure dating back to 2022 against it. Not impossible. What's it going to take to get through there? Volume. That's it.
And then if it does get through there,
then it can go. Then it can
run.
And it has some gaps to fill on the top side. Gaps often fill. This can go for a run back to 300.
Can it really?
It just needs volume.
So what about on the low side? What's the support level?
So the big support level down here on the bottom, and it probably won't break this, it's about $50. I would say 50 is that low level. It's going to be very difficult to get below $50 a share. And if it does, it's going to probably get pulled right back up to 50 because that's the big level of resistance support.
Now, guys, don't follow the people in the community. We have 97 community members who've rated this company a buy. A few have sell and hold. There are other people in the community who disagree with me on a lot of other stocks, but that's what's great about having this community, to see what their reason is. And we even have a discussion board here where people can discuss what their comments are on each individual stock. But let's get right to our stock analyzer tool. This is where we put the numbers and the story together to figure out what's the right price. I'm doing a 10-year analysis here. Guys, first line, revenue growth. I did 3%, 5%, and 7% revenue growth. Okay, nothing outrageous. A little bit lower than the analysts think, but let's stick with that. Profit margin. Guys, as you notice here, I'm going to skip ahead. Free cash flow is always higher than profit margin on PayPal, and free cash flow is the most important metric, the more important metric than profit margin. So I'm going to focus on that. I'm doing 16, 19, and 22. Their profit margin, their free cash flow margin has been declining over the last few years, which is kind of a concern of mine, but I'm still going to stick with 16, 19, and 22. Next is the PE. Remember, we have an increased return on capital. The business is getting better. It's getting above the average. So I'm not starting at 15. I'm going to do 16, 19, and 22. And then finally, a 9% desired return. Guys, this has no margin of safety in it. It's just to say, what's the company worth right now? Now, I want you guys to keep in mind, If you have our software in our community, I'm sure you have very different numbers here. Nothing makes me happier than seeing people in our community chat and even on Twitter share these stock analyzers with different numbers. That's the key to it. This thing is used over 1 million times per year purely because people can edit their numbers. You might know something better than me on PayPal. Your numbers will be different. That's okay. But we're going to hit the analyze button. The stock's currently at $66 a share. This is why it's interesting to me. Focusing on cash flow, we have a low price of 84, high price of 192, middle price of 130. That's a lot of potential between a 12.5% and 25% return over the next 10 years if my assumptions come to be true. Okay, stock number 2, let's talk Target. And like all good investments, we've got to separate the emotion from the numbers. That's really, really key in what we're talking about here. Target isn't just a feel-good brand. It is making serious moves for the future. Here's what's really driving growth at Target right now. They're turning their stores into multi-purpose hubs. In fact, over 95% of sales are connected to stores, whether that's pickup, delivery, or in-store shopping. That means that they can keep fulfillment costs very low while still giving customers convenience. It's the best of both worlds. And guess what? They're planning to roll out 300 smaller format stores in dense urban areas and college towns, places where full-size stores don't fit, but foot traffic is gold. This is a smarter real estate development deployment, and it shows that they understand modern retail. It's all about efficiency. Keep the stores smaller, stock the goods that people want at good margin. And one of my favorite things about Target is their private label brands. These are in-house brands like Cat and Jack for kids and Good and Gather for groceries. Why do I love them? Because they're high margin and they're exclusive. Target owns the shelf and the product. This is how you protect profits from price wars like Amazon or Walmart. You cannot price match something that doesn't exist anywhere else. Now, even though Roundel generated revenue of $649 million, Target executives seem to think it generated over $2 billion in revenue for the company due to its cost savings and other external factors that might have been a nice positive externality to the $649 million ad revenue. They're using all the customer data they get to offer personalized ads to brands, and now they're expanding with in-store screens and AI tools. It's basically turning Target into a media company inside of a retail operation. And guys, that's high margin revenue. They just revamped Target Circle, adding a paid tier, because why not follow into the Costco playbook? More perks, bigger basket sizes, more loyalty. It's about locking in customers and getting repeat business. Now, on the total margin side, analysts expect a recovery to pre-pandemic levels by 2026. As supply chain costs drop and inventory gets cleaned up, those bottom line numbers could start to shine again. But guess what? It's not going to be overnight. Guys, I'm not going to sit here and say it's all roses. There's a reason why the stock is down a lot. Target has issues. Discretionary spending is declining. People are buying cereal, not sofas. Competition, insanely fierce. Walmart, Amazon, TJ Maxx. Everybody wants a piece of the people who are still shopping. And don't forget the big thing that hurt them. Shrink, which is theft. They can't eat into margins fast enough. But here's the thing. Turnarounds do take time. If you believe in the strategy of lean stores, exclusive brands, digital ads, and loyal customers, then you just need to watch for execution. So, is Target worth targeting? If you're looking for a quick flip, move on. If you're looking for a good company navigating these short-term headwinds, then Target does deserve a look. You don't buy the hype. You buy the business. You buy the long-term potential of the business. So let's go see if the numbers match their potential growth. So guys, if you want to look at Target, it's down 36% in the last 5 years. It's only up 51% in the last 10. Hit an all-time high of $240 a share back in November of 2021. It's a $40 billion market cap business with $105 billion in revenue. That's incredible. This is selling for a price-to-sales ratio of the auto business. 5-year profit margin, 4.2%. 1 year, 3.7%. Now, guys, for those of you who love dividends, 5.1%. Don't fall in love. Because in turnarounds, if they start to eat up too much cash, who knows if they'll be able to support that. The good news is those dividends are only $2 billion of last year's $3 billion in free cash flow. So right now they can afford that. And they probably realize that a lot of people are really attracted to this number. Even Mo just said, damn, when he saw that dividend yield. All right. 3-year growth rate, negative. 5-year, 4.5%, 10-year, 3.7%. So that's going to include same-store sales and opening more locations. What do our community members? Our community members have it as a buy right now, but it's a very wide range. We have strong sells and strong buys. 8 pillars. Okay, I'm not worried about this debt.
Nope.
Yep, it's retail, right, Mo?
Yep.
So they're going to have to pay all these leases. That's included in there. I'm not worried about that. Free cash flow decline is important, but you've got to understand why their net income is up while free cash flow is down so significantly. Right. Are they reinvesting back in the brand? Are they doing things? Are they investing into more stores at a higher rate? Are they renovating stores? These are the questions to ask. Guys, these 8 pillars tell a story. That's it. There's not a buy, there's not a sell, it's a story. And right now, we see 9 times earnings on the 5-year basis, 12 times free cash flow. Guys, I cannot repeat enough. My philosophy, and the reason I own Target is I think Target will be around for 20, 30, 40 years, a long time. Women still love it. It does not get ignored. And yes, buying has changed. They're trying to adapt their buying patterns to adapt how they run their stores. This is very, very important. So if you think Target's gonna be around for a long time, I think you should take a look. Now, if you don't care about the business and you just want to trade it, Mo, how do the charts look on Target?
This is below COVID lows.
Is it really?
Yes. I mean, at lows in COVID, you got to like, let's see, $80, $90 a share. You're trading at 87.75. You're just below. But so that's a good thing for if you're looking at it from really any perspective. You are at a base right here. This is a very, very strong base. I would be surprised if they went lower, to be honest with you. And if they do go lower, they're probably going to rebound pretty quickly. But I think this is going to hover here for quite some time. It has a long road ahead of it just because it built in. So as it came down, it started to make these are support levels in here. It's just very tough to break through these support levels. Not impossible. It'll happen. I do think this is going to be around 20, 30 years. A lot can play out.
I think so too. And that's different than the charts. And you know, I started buying Target sub 130. It fell to 103, skyrocketed to like 185, 190, and now it's back down to 87. 10-year analysis, I did 2, 3.5, and 5% revenue growth. It's a combination of costs going up as well as new stores. Profit margin, I did 3, 4, and 5. I actually think this could be low because their pre-pandemic, let's go look at their pre-pandemic margins. Let's see what they were back then. 94 million in revenue. Yeah, over 4% there, over 4% there, 4% there, over 4%. Yeah, so they definitely did over 4%. Yeah. So I'm good with 4 as being conservative. Mm-hmm. PE and price to free cash flow. Guys, they've got a they had an increasing returns on capital. That means a premium. I put 14, 17, and 20. Am I double dipping on the potential margin of safety? Maybe. Because I really want your margin of safety here in the desired return. Like if you don't like the company, if you're a little worried about things, you put a much higher desired return. But remember, I always put in 9% for my intrinsic value. I hit the analyze button. The stock's currently at 88. On a low side, I have 95, high side 250, middle side 160 for an 18% middle return if my middle assumptions occur, and that includes the dividend. Don't add dividend to this 18%. So I think it deserves a look for that reason. You know, this is what's interesting about this Mo. Look, so before we had Stock Analyzer tool, like I know 25 years ago, I bought whatever I thought was a great story,
on brand
right?
Name.
On brand name
like,
alone.
Oh, I use that product, let's buy it.
Yeah, so like Target, I wonder what Target would have looked like 25 years ago.
That's a good question.
Probably a huge gain from there. 2000, it was selling for $17 to $20 a share. So it's up, you know, only 4x since 2000. That's not big growth.
No, it's not.
But to its all-time high of 240, 250, that's a lot.
Right.
But that's the thing that's like, when we're looking at this company, like the way in which I view companies now is vastly different.
Totally different.
Totally different. I mean, I literally don't even look at my stocks that I own for the long haul, and I don't ever look at them.
Well, it's funny. I just said to you the price were lower than COVID, and you go, really?
Yeah, didn't even know. If you'd asked me to guess what the price of Target was, I was going to say 100, 110.
Yeah.
I had no clue.
Yeah.
Now, that's the way I was back in the day. That's the way Mo was, probably more recently because he's younger than me, chasing, getting caught up in the hype. But guys, then I realized something. That's not investing. That's gambling. Mm-hmm. And when I saw the market crash in 2000, I thought to myself, okay, how are all these value investors doing so well and everybody else sucks? Well, once I learned the process and fine-tuned it and continue to fine-tune it, that's exactly why the software was created. Originally created just for me and Mo. We had a data feed and we were doing our own stock analyzer, and Mo's laughing. That's all it was. And we'd make these videos and people would say, hey, how do I get your software? I'm like, you can't get it. It's a data feed. It's expensive. But it obviously, it made us think, okay, well, maybe we should make the software. That's why it was made. So when you're joining EM, you're not just getting this investing software in this really, really popular stock analyzer tool. This thing is used over 1 million times per year just by the existing users in our group. But the point of all this is to create a foundation. We integrate you into the community, offering you free videos and courses that are exclusive to our software so that we all speak the same language. Everyone in our community is trying to level up their investing. So it's important that you have the same mindset along the way. And the fact you've made it this far in this video tells me you're trying to level that up. So before we get in that third stock, I want you to do me a favor. If you're committed to investing the right way, and when I say the right way, thinking long-term, thinking like it's a business, not worrying about day-to-day fluctuations, start your 7-day trial now. Click the link below. We have limited spots each day. So if you're serious, and I truly, truly mean that, I will see you inside the community. Now, stock number 3. Adobe. Mo, this company is incredible. I want to talk about this cash flow. This is the company that everybody was telling me AI is going to kill. In the last 5 years, it averaged $7.5 billion a year in free cash flow. Jeez. Since AI has become popular, it now did $9.6 billion.
It's an incredible increase.
That is an incredible increase. But here's why though, Mo. This gross margin of 89%.
Jeez.
Keep in mind, everybody, I understand this gross margin is very important. It means every extra dollar they generate in revenue, 89 cents of it essentially is profit before taxes. That is how they can generate such big free cash flow jumps. Because think about it. If they went and sold 1 million more monthly subscribers on Adobe software, how much would their overhead increase?
Not much.
If anything.
Yeah, there's nothing to put
But 90
out.
cents of it, of every dollar would go to their bottom line.
Look at the return on invested capital, the 5-year versus the trailing 12-month. That's a
big difference.
That's crazy jump.
These guys, this is a moat status business that I think is getting beaten down. Big number of community members have this as a buy. So a few people have it as a strong sell, but everybody else is basically a hold, buy, or strong buy. Now, guys, remember, look at these growth rates. They've made a few acquisitions, but they're not big. In the last 5 years, their total acquisitions was less than 2% of their entire market cap.
Yeah, it's small.
It was less than 30% of 1 year's cash flow. So they haven't spent much money. This isn't $2.8 billion a year. This is total. And yet their revenue, 10.5% growth per year in the last 3 years, 13.5% in the last 5 years, 17.5% in the last 10 years. Solid. Incredible numbers. Let's go check out the 8 pillars. Oh, I'm actually surprised by this. There is an X here.
Me too.
But I don't care about this. I care about cash flow as much. Because look at the net income. Significantly lower than cash flow. $7 billion last year versus $9.6 billion. So that doesn't, to me, this is an 8-pillar stock.
Yep.
Very little debt, growing its cash flow. Look at this. Revenue up 11 billion, free cash flow up 4.7 billion, net income up 3.1 billion.
Shares outstanding is down about 12%.
Yeah, and they should keep buying more if you ask me. Let's see what analysts think. Well, analysts think it's going to go from $21 a share in profit to $30 a share in the next 4 years. And that's double digit, and revenue growth of 7 to 10% a year.
Really solid growth for a company that size.
Before we get in the stock analyzer tool, we understood the numbers. Now the story. Now this is the company that does Photoshop, PDFs, and probably 90% of the creative work you see online is done using software from Adobe. But it isn't just about creative tools. Adobe is in the middle of this transformation, and AI is the rocket fuel behind it. It is not going to hurt Adobe. It's going to make Adobe better, in my opinion. First off, every tech company slaps AI on a slide and hopes the stock price jumps. Adobe, they're actually doing something with it. They've built their own generative AI model called Firefly. And guess what? It's not just cool tech. It is making money. As of the third quarter of 2025, AI-related annual recurring revenue, that means revenue they have that's going to repeat over and over, surpassed $5 billion. Guys, that's not hype. That's real money. They're weaving Firefly into Creative Cloud tools, basically making it easier and faster for users to create. The more time-saving features they add, the more people upgrade to premium tiers. That means higher average revenue per user, and as a business owner investor, that's music to my ears. Plus, they're using AI in Acrobat and enterprise marketing tools, helping big companies personalize content at scale. They're not just improving products, guys. They're building an entirely new supply chain for digital content. That is a huge idea. Now, for us value investors, here's where Adobe shines. This company runs on a subscription-based model. And like I said before, gross margins close to 90%. That stability gives Adobe the freedom to reinvest in R&D, research and development, to make acquisitions that they have to, and weather economic storms. Now, let's not pretend this is a no-brainer. Nothing ever is. Competition is definitely heating up, especially from design-friendly platforms like Canva. These guys are eating into Adobe's dominance with free or low-cost tools that small businesses love. ROI on AI is the elephant in the room. Just because people use AI features doesn't mean it's going to transform Adobe's revenue trajectory. Analysts are wondering, will this go beyond 10 or 12% revenue growth? But my question is, do you need more than that? I'm not focused on what's the revenue growth. I'm focused on what does the revenue growth mean for the company over the next 10, 20, 30 years, and can I pay a good price for that today? If you told me Adobe was gonna grow at 3% a year, I just adjust my assumptions. That's it. And guys, of course, if we have a slowdown economically, I'm sure subscriptions are the easiest things to end for this company that would hurt them. And Morgan Stanley downgraded the stock recently. But to Morgan Stanley, I'd say, did you downgrade them because of the fundamentals or because the stock is down?
Also, are you going to upgrade them tomorrow?
Yes. And if the stock went to 550, what's Morgan Stanley going to say?
Oh, we upgraded them.
Yes. So guys, if you think you understand the business, how they make money, where the risks are, then I do think Adobe deserves a look. But as always, don't chase the stock. Price, value. We want to find the right price. We want to understand the cash flow. We want to understand assumptions about the future. You don't need flashy stocks to build long-term value. If Adobe is able to grow 6 to 9% a year and you pay a reasonable price and they buy back shares at a reasonable price, this could be a major compounder. So let's get the stock analyzer tool. But before we get to that, Mo, tell us the charts on this one because I'm quite sure it's probably going to be pretty ugly.
Yeah, there's a couple of things. It's ugly right now, but what I'm really liking is, you see this trend down here? We're starting to creep towards this area between these two horizontal red lines. That's the sweet spot. That's where you have the highest probability to make money. Because remember, trading is all about probability. I am actually going to put this on my watch list because if this thing can get above, let's see what this number is. If we can get to like above 375 a share, 380 call it, this thing can go for a pretty nice run to like 420 and maybe beyond that, depending on how much momentum it gets behind it, meaning volume. I kind of like this right now. This is very interesting. This is one of the first times I've ever said that about it looks like a good value play. It looks like a good trade play at the moment. So I'm going to put Adobe on my watch list. Awesome.
Thanks, Mo. So what is the right price to pay for Adobe? Guys, 10-year analysis, revenue growth. Mo, what do you think of this? 4, 7, and 10%. Because by the way, look at this increasing ROIC.
It's crazy. It's basically doubled.
Yeah. Revenue growth, 4, 7, 10. I don't really care about profit margin because the free cash flow is where the money is. Yeah. 38%, 40%, and 42%. And their free cash flow keeps getting better. That's what's incredible. That's that 90% gross margin. PE. I might be conservative here, Mo. I did 18, 21, and 24.
That's fine.
I can understand somebody saying 20, 23, and 26.
I would agree with that.
It's a premium company. And finally, my 9% no margin of safety return. I hit the analyze button. The stock's currently at 361. Mo, on the free cash flow basis, I have 382 on the low side, 820 on the high side, 560 in the middle. Now, guys, what's interesting about Adobe is it's one of my personal Mag 7 stocks. Earlier this year, I picked 7 stocks to go head-to-head with the real Magnificent 7. So click the video on your screen to see which stocks, including Adobe, I picked and how they stack up. Because guess what? If you'd asked me back in January how they do, I was very surprised to see where they are today. Thank you for your time.